In this video, I'll share 5 REITs for huge dividends by 2025. And don't worry, because if you don't know what a REIT is, I'll teach you today. We'll cover the pros and cons, and by the end of this video, you know everything you need to before investing. But first of all, subscribe to the channel if you're really committed to financial freedom and want my help as your rich cousin to grow your wealth. Okay, just an interesting thing. It's so funny because in my country, we have real estate funds and it's completely normal a dividend yield of 12%, 14%, and sometimes 22% and even more. And all of them pay those dividends monthly. In the US, the concept of huge dividend is like 6% and at most bursting 12%. And in my country, we don't pay taxes on dividends. That's wild. Maybe you guys should search for opportunities around the world. And one last thing before continuing with our list of REITs, I want to remind you that this video is not an investment recommendation. I'm only going to present you with some possibilities, but you should study more in depth before investing in anything, okay? Now moving to the first part, what's a REIT? Let's say there's this massive, luxurious hotel with hundreds of rooms. Instead of saving up millions to buy the whole property, you decide to buy just one room. The hotel management takes care of everything, cleaning, renting it out to guests, handling maintenance. You're simply a part owner earning a share of the hotel's profits every time guests pay to stay. This is basically how a REIT works, but on a much larger scale. A REIT is a company that buys and manages properties like malls, office buildings, warehouses, or even hospitals. When they collect, rent, or sell properties for a profit, they share the earnings with investors like you in the form of dividends. Now, let's break down the real advantages and potential risks of REITs in a way that gives you the full picture. As I said, one of the biggest reasons investors love REITs is their steady cash flow. By law, most REITs must pay out 90% of their profits as dividends to investors. This means that when tenants pay rent or properties appreciate in value, you get your share. Maybe it's monthly or quarterly, like clockwork. Diversification is another strong pro. When you invest in a REIT, you're not putting all your money into one building. Most REITs own multiple properties across cities or industries, from office towers and shopping centers to warehouses and hotels. This diversification reduces your risk. If one property struggles, say an office building with high vacancy rates, others in the portfolio could still be performing well. It's also easy to buy and sell, and you can get real estate exposure without the last pro to our list. Real estate tends to hold its value or even appreciate during inflationary periods. As property values rise and rents increase, REITs typically pass those higher rents back to investors through higher dividend payments. And that's cool. And now moving to our cons list. First, dividends are taxed as ordinary income. And unlike long-term capital gains, which benefit from lower tax rates, REIT dividends are typically taxed at your regular income rate. And there's an interest rate sensitivity. When interest rates rise, REITs often take a hit. Why? Because higher rates make borrowing more expensive, cutting into profits. Plus, investors tend to shift money into safer assets like bonds, which can cause short-term dips in REIT prices, even if the properties are still performing well. Then there's management and fees. Investing in a REIT means trusting the management team to make good decisions. But some REITs come with high fees or poor property choices, which can hurt your returns. That's why you should always check the REIT's expense ratio and the team's track record before investing. Another risk to consider is market volatility. REITs are generally more stable than stocks, but they're not immune to sudden drops. If the broader market crashes, REIT prices can drop too, even if the properties themselves are still generating income. We saw this during the 2008 financial crisis when many REITs took major losses. And finally, sector specific risks. Different types of REITs face different challenges. For example, retail REITs depend on foot traffic and consumer spending, so online shopping can hurt them. Office REITs are exposed to trends like remote work, and hospitality REITs can be hit hard by events like pandemics that disrupt travel. And that's it. If you've reached the end of my long introduction to REITs, I know I went on and on, but I wanted to cover as much information as possible. Now we can go to my 5 huge dividends REITs list. First one, it's called Vici Properties. Vici Properties is one of the most interesting REITs on the market, and it's a unique REIT because it focuses on experiential real estate. We're talking about casinos, hotels, golf courses, properties that thrive on entertainment and tourism. Vici owns iconic properties like Caesars Palace, MGM Grand, and the Venetian. So when tourists fly to Vegas, Vici is cashing in on their spending. Now, what's great about Vici? First, they have long-term triple net leases. And that means the tenants, like casino operators, are responsible for maintenance, taxes, and insurance. Vici just collects rent. This setup is designed to provide stable and predictable cash flow, even during uncertain times. They're also built for dividend growth. Their rental agreements include escalators, automatic rent increases over time, so as the years go by, their revenue and dividends typically grow. And let's not forget about diversification, because Vici has expanded beyond just Vegas. They've got properties in regional casinos, hotels, and even golf courses across the US. This reduces the risk of being overexposed to one location or market. But what about the risks? One key risk is economic sensitivity. When the economy slows down, people tend to cut back on entertainment and travel. That could impact Vici's tenants, affecting their ability to pay rent. And also, tenant concentration is something to watch. A large portion of Vici's revenue comes from a few big players like Caesars and MGM. If any of these companies face financial trouble, it could ripple through Vici's bottom line. If you believe in the long-term growth of tourism and leisure, Vici could be a great addition to your portfolio. Before any math, Vici pays dividends on a quarterly basis. So you won't receive your dividends every month, but every 3 months. Now, the dividend yield for Vici is 5.78%. And what that means, if the price of a Vici share is around $29.92 and you invest $100,000, you earn approximately $5,780 per year in dividends. That's around $1,445 every 3 months. And if you're thinking about retiring invested in Vici, know that if you save money and invest $1 million, you earn approximately $57,000 per year in dividends. That breaks down to around $14,000 every 3 months, and you could live on dividends alone. But maybe you want more. You want a bigger dividend yield. And alright, let's move to the second. Second, it's called Arbor Realty Trust. This company have a huge dividend yield of 12.52%. But before we dive into the numbers and the math and everything, let's understand their business. This is a REIT that focuses on a critical part of the real estate market: financing. Unlike REITs that own physical properties like malls or hotels, Arbor specializes in lending money for real estate projects, mainly multifamily housing and commercial properties. So how does it work? Arbor provides loans to developers and property owners who want to build or renovate apartment complexes, office space, or other income-producing properties. In return, they collect interest payments, which become the foundation of their dividend payouts. So what makes Arbor stand out? Arbor typically offers higher payouts compared to most REITs, which makes it popular among income-focused investors. And why is the yield higher? Because the lending REITs tend to take on more risk. They benefit when the loans they issue are paid back consistently, but if the real estate market slows down, defaults can happen. That's where the higher reward compensates for the higher risk. But yes, they also have a diversified portfolio that helps in bad market times. This This REIT is high risk, okay? Since they lend to real estate projects, they're exposed to the possibility of loan defaults, especially during economic downturns. If developers can't repay, Arbor could face losses. That's why keeping an eye on market conditions and their loan quality is crucial. That said, let's move to the math. Arbor Realty Trust also pays a quarterly dividend, just like Vici. With a share price of around $13.74 and a 12.52% dividend yield, if you invest $100,000, you earn approximately $12,000 per year in dividends. That's about $3.1K every 3 months. And if you invest $1 million in Arbor Realty Trust, you earn approximately $125K per year in dividends. That breaks down to around $31K every 3 months. I don't know. Is the risk worth it for you? Tell me in the comments. Moving to the third, Realty Income Corp. Let's talk about Realty Income Corp, often called the monthly dividend company. Unlike most REITs that pay quarterly, Realty Income is known for monthly dividend payouts, a major attraction for income-focused investors. They invest in single-tenant commercial properties like retail stores, supermarkets, pharmacies, and warehouses. Think major brands like 7-Eleven, Walgreens, and FedEx. With over 12,000 properties, they're highly diversified across different sectors and regions. And why do investors tend to love Realty Income? They've paid monthly dividends for over 50 years and have increased them more than 120 times. That level of consistency is rare. Okay, moving to the math. Since Realty Income pays monthly dividends, if you invest $100K with a 5.82% dividend yield and a share price of $54.43, you would receive approximately $485 per month in dividends. That's $5.8K per year divided into 12 monthly payments. And if you invest $1 million, you earn approximately $58K per year in dividends. This breaks down to $4.8K every month. Now let's talk about Vici Properties Trust, our fourth REIT. They own hospitals, outpatient centers, and senior living properties. They lease these spaces to healthcare operators, ensuring a steady stream of income. So why do investors like MPW? First, it's all about a steady cash flow. MPW leases their properties under long-term, triple net leases. That means tenants handle maintenance, taxes, and insurance, so MPW gets a reliable and consistent income. And with healthcare being essential, these properties stay in demand no matter the market conditions. Second, MPW has a diversified portfolio. They don't just focus on one type of healthcare property. They own a mix of hospitals, medical office buildings, and senior care facilities. This reduces the risk because even if one sector faces challenges, others may perform well. So diving into the numbers. Vici Properties Trust has a 6.68% dividend yield and a share price of around $4.8. So if you invest $100K, you would receive approximately $6.6K per year in dividends. And if you invest $1 million, you would receive approximately $66K per year in dividends, but divided into 4 quarterly payments. That means each quarter you would get around $16K. Now moving to the last but not least, the fifth REIT. It's called WP Carey Inc. They invest in a wide range of properties, including office buildings, industrial spaces, and retail locations. There is a long list of pros to invest in this REIT. WP Carey has an impressive track record of dividend payments with a strong history of increasing dividends year after year. They aim to provide investors with stable, growing income over time. They provide consistent, reliable cash flow. WP Carey owns properties that are leased to major corporations under long-term triple net leases, and their portfolio is diversified across multiple sectors, including office, retail, industrial, and self-storage. This helps balance the risk because if one sector faces challenges, others may perform well. Moving to the numbers, the share price is around $55.95 and the dividend yield is 6.29%. If you invest $100K, you would receive approximately $6.2K per year in dividends or $1.5K every quarter. And if you you invest $1 million, you would receive approximately $62K per year in dividends or $15K every quarter, okay? Now I want to remind you that this video is not an investment recommendation. We just did some analysis and you should make your own informed decisions because what works for me may not work for you. Keep that in mind and see you next time.